former Casa colleagues who ran two of our programs, the IDA program, and then she also ran our Community Development Loan Fund. So you'll get to hear from her in a little bit. I'm just going to do a little bit of level setting here to make sure we kind of have a grasp of folks. Hey, those of you on Zoom and those of you in the room have to wait a bit. My name is Peter Hainley. I'm Executive Director of Casa of Oregon. Already went through my bio and the organization, so you'll need to go online if you want to learn anything more about me and Casa. So for the rest of you folks, I just want to do quick level setting. How many of you kind of understand the concept of a loan fund and how it can operate? Just like, I'm going very basic here. We'll take a deeper dive. How many of you know what a Community Development Financial Institution is, a CDFI? Okay, so most everybody. And how many of you understand Community Reinvestment Act and obligations of affirmative obligations of banks to serve communities? How many understand CRA? A little bit. And how? Anybody go to the 101 session this morning? Raise your hand. Okay, so you're fresh. We'll call on you to if I mess anything up. I guess I should also add I'm on the board of the National Community Reinvestment Coalition, which is co-sponsored today with Housing Oregon, and has also worked throughout the country to help banks meet those affirmative obligations under CRA. And those affirmative obligations come in many different ways. You see banks working with affordable housing developers throughout the community. You see banks providing products that are both deposit and loan products to serve lower income folks. Those are all ways of meeting the affirmative obligation under the federal law, the Community Reinvestment Act. The Community Reinvestment Act is enforced through exams that banks undergo every 3 years. And these exams are done by the three regulatory agencies that issue charters to those banks. So Federal Reserve Bank, Office Comptroller of the Concerns, Office of the Comptroller of the Concurrency, the currency, not the concurrency, and then the Federal Deposit Insurance Corporation, Federal Reserve Bank, FDIC, OCC. So those are our acronyms for the regulatory agencies. And so those exams take a pretty deep dive into a bank's work in meeting the CRA Act. And one should, if you're wanting to know how your banks are doing, there are websites that you can go to. And the one website that is comprehensive that will link you up to all of the different regulatory agencies is the ffIEC.org. And that's where you can get information about how banks are doing on their CRA exams. I believe on that website, you can also, if not there, you can go on to the individual regulatory agencies and find out when upcoming exams are going to be going to your bank. So you can take that time. It's an opportune time to go to your banks and ask them how they're serving community and can they be serving the people that you serve better or differently. And that's just a great time to be able to make contact with them. And if you don't feel like you're getting anywhere with the bank, then you can always write a letter to their regulator and ask that it be put in their file. That sometimes and oftentimes will get their attention. You could also join NCRC and we can do some deep dive into some of the information that banks are required to provide to the regulators if you are looking for some additional information on some of those folks. Now, we recently had a spate of mergers here in the Pacific Northwest. And if you were at lunch today, you heard about the Columbia Umpqua Bank merger. And I had personally worked on a couple previous mergers with those two banks in previous mergers. So when Umpqua merged with Sterling, when Columbia State merged with Columbia. And both of those times we were not able to get a community benefits agreement out of them. And so third time was a charm. When I called the CRA folks at Umpqua, I think they understood that it was time to have some conversations with community, and conversations they did. They did it willingly. They did it in a respectful manner that has led to a really good community benefits agreement. And so, you know, you can find that community benefits agreement on their website. There's an advisory committee that will be tracking their progress on it. And I would encourage you to take a look at it and see where that community benefits agreement, where the work that you do in the community shows up in that community benefits agreement. And, you know, if there's questions that you have, certainly the folks from Umpqua who are here in the room, if you could raise your hand just in case folks want to talk to you after this session about that community benefits agreement. Of course, they won't be able to talk about the whole thing because they only serve small pieces of it, but want to thank them for the work that they've done. So now to the thing at hand. I mentioned all of that because I wanted to help you to understand some of the best times to make sure that banks are serving your communities. And a merger is one of them, because the merger has to be approved by that regulatory agency. So it's really kind of the key moment when you have some leverage in asking the bank to do what their affirmative obligation is under CRA. Hopefully they've already been doing it, and hopefully that's reflected in their CRA exam score. Though you could look at those scores and you could say, well, it looks like there's been great inflation over the years because it looks like everybody is, you know, an exemplary organization. So I bring that up because I think it's important for us to you know, keep our eyes open when we see these mergers, because it wasn't just this one. We had two other mergers in the Northwest over the last couple of years. The other was BMO and Bank of the West, and then US Bank and Union Bank. And the BMO, Bank of the West, and CRC also helped negotiate a community benefits agreement on that one. The Union Bank and US Bank, I believe California Rural Coalition really took the lead on that one, with NCRC kind of sitting in the back seat. But if you look at any of those three agreements, you're going to see some pretty big promises that the banks have made to serve their communities. And so, and one of those promises you're going to see is lines of credit to serve the communities that we all want them to serve. And so I'm going to stop talking now, let somebody else have the mic for a bit. We're hoping for audience participation here. So there's no presentation here. Raise your hand if anything you hear that's been said so far and you have a question about, and we're just going to take those as we go. So I guess I'll stop there before I hand this off. Does anybody have any questions for me? Comments for me? Okay. I'm going to hand it off to Maggie. Maggie?
Thank you, Peter. Hi, everyone. Good afternoon. My name is Maggie Reilly. I am a commercial lender at a nonprofit organization called Craft 3. We are a community development financial institution like Casa. And over the course of the last 25 years, have invested several $100 million into ecological, family, and business resilience across the Pacific Northwest. So our footprint includes both Oregon and Washington. I'm based here in the Portland area. And you may know, as in introducing myself, I am a commercial lender. So translation, work mostly with small businesses and nonprofits who need access to capital, who cannot get their needs met from a traditional lender. Over the last couple of years, and especially as part of our new strategic plan, which is located on our website and quite excellent, I must say. We reframed our strategic priorities to include housing as one of the investment areas that we care about through our commercial lending arm, especially in response to three regional challenges that we identified as a mission-based lender. And those include rural and tribal economies, systemic racism, and climate. And so our investments moving forward, the lens by which we start addressing those three very small issues in our region, no big deal, is through housing, essential services, small business assets and growth, and then community climate adaptation. So when we think about housing at Craft 3 as a loan fund, and our loans range from $25,000 is the floor to 4 million, sometimes larger, depending on the transaction. We really are looking through those lenses and looking at prioritizing investments in those different sectors. I suppose as I kind of round out the introduction, we are like Casa and many other CDFIs. Our loan fund has, I think we have upwards of 120 different sources. We have a pretty complex loan fund in terms of sources. They fall into 4 main buckets. One of those government, another one philanthropy or foundations, accredited investors or people who are mission-based investors and want to invest into our loan fund, and then banks. So banks included through CRA play a not insignificant role in our ability to invest capital into areas that we care about that also align with banks' priorities and financial institutions' priorities. The other place where we work very closely with banks is actually through lending. And I'll do a quick shout out to the ladies in the back at Beneficial State Bank. As an example, we work really closely with mission-driven lenders, including those like Beneficial, and calling you out as an example. There have been a number of times when Beneficial said, hey, we really want to do this deal, but we can't get across the finish line without another lender. And so Craft 3 will come to the table, usually in a subordinate position, when there's some kind of credit challenge or just reason why the whole deal can't be done on their own. And so we love working with other banks. We also love working with other nonprofits. And so shout out to Reach CDC, also in the room. Another example of how we work with other nonprofits, other CDFIs, is through participations, mainly with you probably have heard of Network for Oregon Affordable Housing and the Community Housing Fund. They're also housing CDFIs based in Oregon, where we buy participations as part of a greater pool. Those are some local examples of how we engage in the housing market. Increasingly, however, we've seen the need for pre-development and construction financing for homeownership projects that can't get access to capital through traditional programs, so full stop there. And that's been pretty exciting because those projects have been highly mission aligned. And by that, I mean, they might be net zero construction, homeownership in partnership with a nonprofit. So a wealth creation opportunity. And the marketing plan that nonprofit has is targeting communities of color or people who are low wealth households. And so all of that is to say, while we are not a traditional housing lender or housing CDFI by any means, we increasingly are playing a role in this space because we see the need there. From a credit perspective, are we going to get into the credit? I don't want to bore the audience or delight you. I would say we have a pretty flexible credit box compared to most, similar to most CDFIs. We're definitely a friend to come to if you have a project that for whatever reason doesn't fit the credit box of a traditional lender. We have more flexibility and we have mission alignment on our side. And so the lack of, so because of that, we are able to invest in spaces and fill a gap that banks cannot, with the hope, of course, that eventually they can either go to a bank or in the case of perhaps a pre-dev or a construction loan, they'll have permanent finance coming from a financial institution, a regulated financial institution. I'll pause there, pass it over to Dan.
Or any questions for Maggie? We'll come back and do questions for everyone, but nothing right away. Okay. So yeah, Dan Valliere, Reach Community Development. Reach is, nonprofit organization, very much like many members of Housing Oregon, right? We're really where it's interesting, right? Kind of where Peter, you were saying, we're kind of this, we're at this like intersection. We're like helping financial institutions deploy resources through this system of community reinvestment, which was hard fought to even create many years ago, right? That it wasn't just something that someone said, oh, let's do it. That was like a fight. It didn't even happen until there was a fight, but it did happen many years ago. And now, yeah, there are many great financial institutions who respect that process, who really do well with it. And that's great, but not all do. So there still needs to be pressure. But those in the room today, thank you, because you obviously do take it seriously. You come to Housing Oregon. But for nonprofits like Reach, you know, and our colleagues in the room, you know, it's like we're that intersection, right? We're helping financial institutions deploy resources in communities to create communities, housing communities, affordable homeownership opportunities, savings opportunities, asset building opportunity, like all kinds of things. Obviously for Reach, we largely are doing that through development and long-term stewardship of rental housing, but we also do home repair programs to help homeowners. And then we manage and provide services in the community. So we're really focused on creating, you know, a home, a place where people call home and feel like it's their community and they have control over it and have access to amenities and resources that it's not just a box, right? It's a real great place to be. So that's what we're about. That's what a lot of our peers in Housing Oregon, that's what we're all about. So to do that, and I think we want to get to this line of credit topic because that's really the heart of this thing. You know, to do that work, increasingly, it's getting really hard. It's getting really competitive, particularly for community-based organizations to do the work, because there are many other kinds of entities that can do development. But we do it with very specific, again, community priorities, community outreach, long-term stewardship of the communities, right? That's what these nonprofits are about. There's no owner, right? That's one thing I always tell people, like nonprofit, they're like, there's no owner. And they're like, what do you mean? It's like, because literally no one owns it. Or if you want to talk about ownership, it's the community that owns it, right? Volunteers are in charge of board and the staff, we don't get, you know, share, we can't distribute money to ourselves. You know, it doesn't work like that, right? Whatever extra resources just goes back into the mission. So we're really unique entities. To do this work well, we need to have capital, and particularly that pre-development piece, because you have to take a lot of risk in development, right? So you have to have that risk capital, that pre-development capital. But by the way, how risky is it? I mean, if that's the other thing that I wish we could do a better study on. If you look at history of time of Housing Oregon members and all the pre-development resources we've used, and how risky was it? Not at all, right? Like it's like all come back and all is like, we know what we're doing. So this isn't risky stuff. And we have a track record and a long-term like concept that proves that. And again, the banks in the room, you kind of know that because you're doing the work, but we need more banks to also get that. So how do we spread that understanding of like, this isn't actually high risk, unlike, you know, other kinds of leverage of real estate. There's risk, but we know how to manage it in our community of practice, we kind of manage it. Okay, so now I'm going to just take you into Reach for 1 minute under the hood. So like you can see how it works for us and what we're doing. So we have some pre-development capital, right? That we revolve, you know, we spend it pre-development and then when it closes, it comes back to Reach and then we can do it again. You know, sometimes for specific projects, like if we're doing a big land acquisition, we're going to work with Craft 3 or NOAA and like you're going to help us with some land acquisition. So we do those types of things. So I'm not talking about that so much. I'm talking about just flexible capital that Reach has to, you know, do the design, to do the all the pre-work to get it to construction closing. That we can decide what project it goes into. So it's not for a specific project. So we right now have about $5 million of pre-development like loans that are to Reach that we can then deploy in different ways, which is good. It gives us enough to do, you know, a few projects at a time. So Reach has grown and that's like really good. And actually, I would argue though, like that's still not enough for an organization Reach's size. And for some of our peers that have a harder time getting even that, like we all need more of that. And I really would advocate right now, like let's Reach get new, like we need other organizations to be able to get these types of resources. But here's the punchline. So how much of that comes from banks versus foundation, like in the form of a program related investment, which we could talk about that if you don't know, ask a question, or CDFIs. So who's the top? Who's given the most percentage of the 5 million? CDFIs, foundations, or bank? And this is just for Reach. I'm not talking about the whole world, but at Reach. Any guesses? You're right. So that people know what's going on in the world. Yeah, and that's shifted, right? That's shifted a lot over the last few years. So yeah, foundation PRIs is like 70% for us of that 5 million. Banks are like 10%. So we don't have much that comes direct from banks, and then the balance is CDFIs. So yeah, so I mean, the punchline is like, how do we get financial institutions to get back to this work? Because it used to be more available. In fact, one of our biggest bank-based sort of pre-developed sources is one that we've had forever. It just keeps getting renewed. But like, if we tried to get a new one from them, I don't think they would do it. It's just because we like have had it so long. And one of the ones we have with another bank is going away right now. They're actually making us like pay it down because, you know, it's coming to its maturity, but we were like, hey, let's renew it. They're like, no. So, I mean, things have shifted in the banking world with this idea around line of credit for pre-development. And I don't honestly know the whole background. Love to hear from others on like what's shifted, but it's a problem. And I think we need to kind of unpack it more. So I'll stop there.
So I'm just going to give a little bit of background on how Casa started its loan fund to kind of give some ideas of what we did to raise money from banks. And the first bank that lent us money, $35,000 non-recourse, was Security Pacific Bank, which was a precursor to, well, it wasn't a precursor, it was a small bank bought out by Bank of America. And when Bank of America bought them out, you know, it was like, oh no, the big guys are here. They're going to take it out. They're going to take this away from us. They didn't do that till 10 years later, but nobody from Bank of America here, right? So I'm not offended. Okay. I would say it even if they were here. So, so Bank of America raised it to $90,000, then raised it to $300,000. And then, like I said, 10 years later, they called it and said, we no longer offer that product. In the meantime, though, we were going to the foundations to, you know, really pitch what it is that Casa does, our work in the community developing farm worker housing. And so we found our first foundation investment was through Northwest Area Foundation. And so, you know, while we're here to kind of talk about how to access lines of credit from the banks, it's really a multi-pronged strategy that you've got to use, because the only way you're going to get more bank investments is if you show a really diverse investments from other folks and putting your own earnings back into the pot. That's really how you're going to be able to grow that pot. And so, you know, that bringing Northwest Area Foundation in was great. It was a 3-state revolving loan fund for 3 organizations that served farm workers. And, you know, from there, we were able to kind of pitch this to other banks and started, you know, we got some EQ2 investments. Who knows what an EQ2 investment is here? Anybody? All right. So an EQ2 investment, it's equity equivalent. That's why they call it EQ2. And for the banks, they're able to count it as investment in their CRA exam. And that's really important because they get extra credit for being able to actually provide, you know, what looks like equity to you rather than a loan. Okay. Well, it's not really equity because you do have to pay it back. But the beauty of it is it's longer term and it's very low interest rate. It's got to meet certain criteria to be able to qualify as an EQ2. And so when we got those that Bank of America was not called an EQ2. The first EQ2s that came in to Casa were US Bank and Wells Fargo. And these were, you know, very favorable interest rates, 2%, 7 years with renewal options. And from that point, then we were able to start going to other folks and start asking them to invest, or they were coming to us because they had heard about the work we did with farm workers or in rural areas. And so we, you know, started talking to hospital systems, because nonprofit hospital organizations are required to do needs assessments regularly about how they serve the community, not just with free patient care, but also housing. Because if you look at a number of the hospital systems, they're realizing, you know, some of those benefits that are conveyed by having good housing means less visits and more money, or less money for them to spend on indigent care. And so you're seeing investments from some of the hospital systems. And then there's the religious organizations. Oftentimes you will, you know, be able to get, I mean, here in the state of Oregon, the Holy Name Nuns have been very good about investing in organizations in loan funds. And I'm not just talking about investing in CDFIs. I'm talking about general loan funds, because, you know, to become a CDFI, you've got to go through a certification process. You've got to be continually, you know, doing reports and showing the federal government that you are worthy. And it's a lot of work, as Maggie can attest to. That's, you know, she's, I think, happily doing lending now, knowing she doesn't have to do U.S. Treasury reports. But being that CDFI designation doesn't just bestow upon you that you're a worthy lending institution. It also gives you the opportunity to receive money from the federal government. And that money is typically, I don't know how it works anymore, but it would match is it still match? Is that how they still do it? It match, you have to provide a match. Yeah, for the TSA. Okay. Anyway, it's okay. All right. Well, that's good. So, you know, they're giving you equity money. You're not having to pay it back. In the early days, they would match whatever terms you had. So if I had a 7-year 2% bank loan, they would match it 7 years, 2%. So that's good. You can see how long I haven't been doing lending. You know, so the key to continuing to be able to raise this money is, like I said, showing that you've got some skin in the game. Casa currently has plowed about $6 or $7 million of its earnings into its loan fund. And so, you know, we have a 33% equity makeup in our $20 million loan fund. The rest is from those other sources that I mentioned. I didn't mention one source, and I know Craft 3 has been able to avail themselves of some state funds as well. So the state has also invested in CDFIs for some particular purposes. So all that said, I think, you know, the key to a loan fund, to starting a loan fund, to getting money from any number of sources is, you know, just being very clear about your constituency, who you serve, and being sure that you can tell a good story about how you serve that constituency.
If I can build off some things that you said, Peter, and since we have some bankers in the room, another reason why EQ2s are so important for a CDFI or another lender, and for those of you who aren't as familiar with them, two things. Typically, they're no recourse, but they also sit on your balance sheet. So we can use them to leverage other resources to help grow our loan fund in order to do more together. And so that's a key benefit to EQ2s that differentiates them from other straight up types of investments. The longer term or maturity obviously is very attractive as well. In addition to no to low interest rates, CDFIs, because we have a cost of doing business, right? We have a spread on our cost of capital. And so if our cost of capital is 3 or 4%, for you as a nonprofit developer, that becomes 6% or more. And so for those of you who are in the position of power to be investing into loan funds, the lower the better, really, and especially if you're getting the CRA benefit for that. And then two other things more for those of you who are nonprofit developers and thinking about, how do I finance a project? Is it a term loan? Is it a line of credit? What do I need for my pre-development or construction loan? One good rule of thumb, not stating the obvious, or I am stating the obvious. Typically, you want to find your debt facility to meet, or your credit facility to meet the use of what it is you're going to do. And so a lot of times we structure our loans as a non-revolving line of credit. Effectively, it's a term loan with a long drawdown period. And that's very different from a typical line of credit that has a renewal, like these two gentlemen were describing with their projects or with their overall investments into their nonprofits. We also, as a nonprofit, have, and the boards that I sit on have lines of credit, operating lines of credit, and that's a very different use than what you would have, which is project-based financing. So just something for you to keep in mind as you think about how to put together your capital stack for the research and resources that you need to get something off the ground. Peter also alluded to that we've been lucky enough to get a small, relative to our loan fund, but investment from the state that's specific to co-locating affordable housing with early learning facilities. That's really exciting, but it's only $10 million. And so the state needs to do more to invest into this space through CDFIs. We're a very capable type of lender, I think. Yeah. We get the money on the street. We understand risk. And to Dan's point, on the surface, sometimes construction and pre-development loans feel really risky, but if you dig deep into who we lend to, we know our customers, we know what projects that we're working on, and we have a really good understanding of the local market, and that mitigates a lot of risk. Another thing that we do as a lender for our construction projects is use a third-party construction monitor, which also mitigates risk. And so CDFIs are very not only capable, but fairly low risk investments, if you will. I know, actually, I think I could speak about all of the CDFIs statewide, and I want to say our losses are probably competitive with or lower than a bank's, like big picture, I'm going to guess. So those are just some other notes, depending on who you are and what you do in this world related to construction, finance, and housing. Finally, for those, and this is wearing my commercial lending hat, for those of you who are, nonprofit developers seeking to, again, like capitalize a project, in addition to thinking about what project-based financing you need, also think about how you as an organization can build your balance sheet and be in a strong financial position so that a CDFI or a bank is going to look back and say, hey, you've reinvested your retained earnings, if you will, back into your organization. You're growing year over year. You don't have historic losses. You might have a healthy amount of like days of cash available. So just thinking about, we did this at Casa, which I thought was pretty ingenious. Basically KPIs for your nonprofit to think about, like, what financially do we need to show in order to measure our own success internally. And that can be something that can be really valuable for you or for your board, depending on how you operate and who's at the table. But it can be just like those quick measures of financial health, especially if you see a real estate project coming down the horizon. So that's just some other tips that have worked for us as a CDFI, and I've seen, and we've gotten more comfortable with risk in lending to nonprofits for facilities, community facilities, or housing when those kinds of indicators are stronger, or at least leadership has an idea of what those are and can tell us a story for what happened, especially given the volatility of economic conditions during the pandemic. And currently we're in a pretty unprecedented interest rate environment as well. So that I think can help you all as you talk to banks or CDFIs about your project. So.
I know. Yeah. Well, yeah, we got questions. We're still
So
opening it up.
I was going to go for a minute. So I'm Brett. I work for KeyBank, so I am a traditional lender, and I do lines of credit not irregularly. And in fact, I do affordable housing lending is kind of my specialty at KeyBank. And I would say using lines of credit is one of the things that's been successful for me in my business. With that said, most of them have been made to private sector guys. And to pick up what Dan was saying, part of the reason I can loan to private sector guys is because there is someone there. They personally make a guarantee. And so one of the challenges from a lender's perspective to make that same loan to a nonprofit, there is no one to look to write the stroke the check if there's a problem. So we all have to sort of figure out what that means. With that said, the other side is that I do have multiple clients that have multiple $2, $3, $4 million lines of credit, and they can take that money and go out and buy land, pay for architects, do other things. And so I can see it's a very valuable tool for them, and I like it. And I haven't done it as much on the nonprofit side, and it seems interesting. And I think it's something that could be pursued more. And from a lender's perspective, one of the things we're going to look at, again, the sort of retained earnings. If you want a $2 million line of credit and you have a balance sheet that has $1 million of net worth on it, I'm never going to get that through credit. How can I lend you $2 million when you're not even worth $2 million? So those are the kinds of things that we're going to look at. Another thing we're going to look at is how much revenue do you have? If you generate $100,000 in revenue and you want $2 million, that would mean it's going to take you, I can't do the math in my head, I'm only a banker, a number of years to pay me back. It doesn't make sense. So conceptually, this is the kind of things that do. And so part of what I've done with my clients, and sometimes they're more sort of startup for-profit guys, is I'll say, hey, I'm only going to lend you $500,000 this year. My lines of credit are only for a year, and then they're renewable because I want to give you not a lot of rope. So if the event that things aren't going well, we'll take that line of credit and I'll give you 2 years to pay me back. So I try to give you some rope, but that's kind of how it works. So generally speaking, I might lend you $500,000 the first year. Turns out after that first year, you guys have done cool stuff. You figured out how to pay me back. You've rolled it over. You put it into a deal. The deal closed. I got my money back. Well, now we have to renew. Now is an opportunity to take that $500,000 line and move it to $1 million. Theoretically, at the same time, your organization has grown. Your net worth has also grown. So that's sort of how I am using lines of credit more on the private sector side, but there's zero reason we couldn't do the exact same thing in the nonprofit sector, understanding that the underwriting will be different. There's no rich guy that we like having a rich guy at the backside. So, but to Dan's point, if it's a nonprofit that's been around and they've reinvested their earnings and they have multiple $1 million of net worth, nice job, Dan, that helps. So that's sort of the thinking of a more traditional lender. And I thought I would just go ahead and share with you sort of how we think of doing lines of credit and how I've been able to use them in my business.
That's really helpful, Brett. Thank you. Yeah, I think there's something to really, this is why this is a good venue, because like there's stuff to explore there. You're right. Like, I think we've had those conversations where, so for Reach, it's like, you know, we have some reserves, although we don't have like masses of cash reserves, but we have some, but then there's a lot of assets because Reach has been around a long time. And so for all the organizations that have been around a long time, if you eventually you fully own some of the assets, or they have, much less debt on them. So that's been part of the discussion, I think, is what you're getting at. It's like being able to show something to back up, even though we can show it's not that risky, like, well, but in that case, like, what's your backstop? Yeah, that's the question we have to answer. And maybe there's also ways collectively our field can answer that question for nonprofits. It's another thought that we could all explore, right? Like, of how do we create that rich friend out there, but who isn't actually putting all the money out there, but is just providing that guarantee. Like, maybe there's ways to do that, because that would sounds like maybe serve the same purpose for a bank as like how to answer those credit committee questions is what Brett's getting at. Thanks for honing that in. I think you're right. And I'd be curious other thoughts on how people have gone at that.
One thing that we've done actually as a nonprofit lender, when we can't get comfortable, is work with the foundation. And so that's another way that you all nonprofits can say, hey, we have a lender that's willing to come to the table, but they need top loss guarantee or something like that. And so that's certainly an avenue for you all to explore. And I've done that with a couple clients where we couldn't get comfortable. And so, and that was newer developers, still high mission project for us, but we needed a little something extra to help us feel comfortable from a credit perspective. And so that's certainly something that obviously governments offer these as well. Foundations can be a little bit easier to work with, but do have that relationship need. And so it's another tool in your tool belts on the financing side that can help you on a more complex project. Or if you're just newer to the process and haven't yet developed that pipeline of projects, perhaps with your own model of, if you're newer to housing development, you might want to consider projecting out several projects. Like, okay, how are we going to financially make this work if we don't have a rich guy or gal backstopping the project and signing on the dotted line, right? So keep that in mind. As a nonprofit, sometimes it feels like a lot more work because it is, but these projects are very worthy and you will find those partners coming to the table. Another partner actually related to that, governments, we alongside Community Housing Fund and Network for Affordable Housing launched earlier this year the Missing Middle Housing Fund with the city of Tigard, and they utilized a portion of their ARPA funds, the largest component of their ARPA funds, to put into a pool, and we're working together to create these kinds of housing units in the city of Tigard. So very niche market, but, small geography, but I think those kinds of public-private partnerships are really good examples for what we can see in other municipalities as a way to create more units, solve the access to capital question for a lot of small housing developers, and ultimately do what we all are here to do, which is house Oregon. So as those opportunities, I don't know, keep your ears to the ground, or eyes peeled, what's the expression? If those kinds of things are percolating in these conversations in these rooms, tease on them a little bit, pull at that thread, because you don't know what you're going to unravel.
Go ahead, Gina.
I'm Gina Leone. I'm with Umpqua Bank. I agree 100% with what Brett's saying and the rest of the panel. I wanted to add one other concept to the idea of adding or requesting or contemplating lines of credit from a lender perspective. So lenders think about, how does a loan or a line get repaid? So we've kind of talked about that. What are your liquidity sources? We also think about, what are other potential drains on cash flow to the company that's asking for the line of credit? So I would be thinking about, what other projects do you have underway? How are those going? Are they on schedule, or are they behind schedule? Are they already drawing resources from your cash flow? I also think it's all about telling a story. So what's the need? Where is the need? Have you done it before? Have you successfully built projects and taken them through the application process with OHCS? Telling that story and showing that you have the expertise to bring that project through to support a pre-development line of credit can be very helpful to a lender. So if you're thinking about, okay, I want to make an ask for a pre-dev loan, having some of these pieces to put together when you go in and make the ask is going to help your lender be in the best possible position to actually make the ask. I think that's all I want to say. Well, I'm sure there might be more questions, but I just wanted to add that additional color, like, help us tell the story on your behalf. It's about how to get repaid. It's about your expertise. It's like working together to tell the best story and create the best structure so that we can start having more traditional lending institutions providing these products. It's not that the people that work for these banks don't want to provide it. It's that we work for federally regulated institutions that keep us within boxes, and we have to figure out how to navigate that, and telling the story well is really, really helpful.
Thanks, Gina. That was the safety and soundness little bite that we all need to hear, because they're making loans based on the 5 C's, and I'm full of character, but I might be missing the other 4s, which I won't go through right now. One other thing, I just wanted to mention that NOAA was brought up, Network for Oregon Affordable Housing. They're an affordable housing lender here in Oregon. It's a consortium of banks have come together to provide funding through them. I used to sit on that board. And then Community Housing Fund, CHF, is in Washington County, and they're a consortium of city and the county providing funding for affordable housing. So there's different ways that folks get these funds together, and then there's different ways that they're put out on the street. So go ahead.
Hi, thank you. My question's for Maggie. Early on, you mentioned that your Craft 3 is doing more to support and lend to and fund projects for home ownership. And I was just wondering if you could share a little more about like the strategy behind that, like the intention to be more supportive or be more intentional about funding home ownership projects.
Sure. Thanks for that question. I would say it's driven by 2, maybe 3 key components. One, we lend in places where other lenders don't. So CDFI is we're limited to what we can do and where we can do it. And to the extent that we can be cooperating and leaning into spaces where others aren't, I think that helps the rest of us spread our small peanut butter jar as thinly as possible, or thicker, I suppose, in the communities that we care about. So that's one driver for this. 2, the projects that we have seen have had incredibly high, mission alignment. And by that, I mean small business assets and growth is one investment area that we have identified as a way to attack two of our regional challenges that we outlaid in our strategic plan. So there's pretty high mission alignment, I would say. And then 3, not only is there mission alignment and we're leaning into a space where others really haven't, but there's also public subsidy there, which means we're not the only lender at the table or financing provider at the table. And so we're working with others and we're building off others' presence in the market, particularly with experienced developers or where there are partnerships with experienced homeownership agencies or nonprofits, if you will. For the other piece for a lender, we want to know, how are you going to use our money and how are you going to pay us back? Spec housing is of zero interest to us, as it is probably most other housing and most other lender out there. But there are plenty of hard money lenders that operate in that space, and that, to be honest, like provides, like, that is a space that needs access to capital, and they do their thing. And so because of these relationships with nonprofits that are working on the homeownership side, that helps mitigate a huge amount of risk for us as a lender. And so that's kind of a third piece that's not insignificant to that decision making. We're still very new to it. And so it's possible that we might in a year say, hey, we want to touch the brakes on this. And I suspect that many lenders in the room are saying that about housing in general. Hey, interest rates are really volatile right now, and that while the Fed rising rates isn't directly tied to mortgage interest rates, they're related. And so, maybe we want to wait and see what happens next. I think a lot of lenders are saying, let's see what happens. So I could see us doing something similar depending on what happens with greater economic conditions as well. But thanks for your question.
And if I could just add one other piece on the homeownership. And you guys are doing homeownership on replacement of mobile home parks. So I'm going to answer part of the question for her. They have a program that they've developed to help replace mobile home units within parks. And that was because of some of the work of nonprofits like Casa and others were doing in that space to make sure that we could really kind of attack that problem. But the homeownership in Oregon, I was hired as a homeownership developer 30 years ago at Casa to do a community land trust model for farm workers. That's a hard population to serve with a homeownership model. And what I learned really quickly is if there's not policymakers that are really leaning into it, we're not going to really make many dents into it. And you have to remember, the state of Oregon only established a homeownership division 6-7 years ago. Go to the state of Washington. They've had one for probably 40 years. Go to the state of Utah. They got different structures. So that's part of it. I want to throw that policy piece out there because that's really important. The state invested a bunch of homeownership money in the last couple legislative sessions, mostly the one previous to the last one or the one before that. And the policy isn't there still. And if we don't have that, we're not going to be able to do it. And when we're paying $550,000 to develop rental housing, and we could be giving something for longer term appreciation, equity development in the community, particularly BIPOC, we should really be doing that. So thank you for that question.
So I hate to be negative, and I'm sort of glad I don't know the answer to this question, but what happens when a pre-development loan can't be repaid? And is there a difference if my loan is with CDFI or if my loan is with KeyBank in terms of the consequences to the borrower? Something goes sideways.
We've never had a loan go bad, so you want to?
Go bad.
Yeah. No, generally, I think that's probably gets to Brett's point is like, organization has to have some kind of way to protect yourself against that problem. To reach, we haven't had pre-developments generally come back, so that always has worked out, but sometimes it takes longer. Yeah. Right. Generally, try not to get too far down the road. So I guess that's true. There's a control on just your decision-making process. If it's a project you're not sure about, be careful about how far down the road you go. Yeah, I mean, in our pre-development pot, we have the borrowed funds, and then we have also a percentage that's like reach funds. So I guess that's the other protection, is have a little bit of your own organizational funds in that pre-development pot. So if something happens, then you've got that to take care of it, so you can keep the relationships with the lenders. You know what I mean? So just having that your own piece in the pot, even if it's 10 or 20%, it's something amount that could handle that problem, and don't try not to get too far in. That's how we've handled it.
And mechanically, most lenders are going to have some of security agreement. If you have said, hey, we're going to, if it's land, obviously dispose of the land, but there's typically some kind of recourse baked into the loan that's going to be unique to each lender. So like Dan said, it could be it's coming out of your it's coming out of your nest egg, if you will, or it's coming from net proceeds of the land. It could be some other depending on, you might have the property or project cross collateralized with something else. There might be some other way of shoring up collateral if there's not actual collateral for the bank, beyond your own organizational balance sheet.
Yeah. Stations that you described that do talk.
Yeah, and also all CDFIs have some loan loss reserve. So, we've got some amount built in anticipation that something's going to go wrong.
Hi, I work for a local funder, and I believe you're probably aware that our state funding organization is doing some engagement around realigning their funding programs for affordable housing. And I'm just wondering, you mentioned policies that support this kind of work, and I'm wondering if you had a wish list of local or state policies that would support this kind of lending to nonprofits, or getting more out of that lending. What would you ask for?
Oh boy, you go first.
Sure. I mean, a preference for nonprofit community-based organizations in all funding. Because it's deserved and merited because of the track record. And that I would think, I can test this with the bank and financial institutions in the room, but I would think that would help show oh, wow, okay, so the funding, our odds are now better because there's this preference in the process that organization, okay, cool. That doesn't remove all risk, but that definitely helps increase the odds that our projects are going to be prioritized. So that would be a big one.
Loan guarantees, capital for CDFIs, perhaps a lens of a credit elsewhere test, not like a true credit elsewhere test, but something that's so that resources are being accessed by those that don't have as much capacity. I think it's, from a public policy perspective, the role of government to take more risk and lean into spaces that align with the public good, of which housing is obviously one. More money for CDFIs and our loan funds.
Maybe places where this
restricted affordable housing. There also aren't a lot of developers that work in that space. Again, big picture compared to rental housing. There could be sector specific areas that might have a higher, might be more either perceived high risk or actual high risk that the banking industry just stays away from, that we might lend into. And that also could be for mission alignment as well. It's typically where I would say there's some, I would say typically it is something that is either market condition or like the 5 C's of credit. It could be that from a collateral perspective, we will take any and all collateral available, but we're not a collateral lender. And so there's insufficient collateral or collateral shortfall or none. That's not a deal breaker for us. But I know for some financial institutions it is. If there is a loan to value shortfall or a loan to cost shortfall, that's not always a deal breaker for us. For some institutions, it can be. And so again, we just have we have a bigger credit box because we're not regulated by our friends at the OCC, Federal Reserve, and here's the other FDIC. Thank you. So that gives us a lot more latitude into what we can do and how we design our credit box. Did that answer your question or give enough like concrete examples? Okay.
Hi, Maggie. Peter Clements. I work with Dan at Reach. And another, thing that I was really impressed by with Craft 3 was a couple of years ago, we had a project that didn't go forward, but we explored with you where we had a non-residential component of the project that was a Muslim organization and needed a halal product that was structured in accordance with Islamic law. And, you were able to develop that. And I think it was tremendously exciting and, thought it'd be worth mentioning.
Thank you. Actually, and that one, we ended up doing a second. I was so sad that project didn't move forward. And we were able to do a different, thank you for that shout out. That's so kind. And this organization's amazing. The African Youth Community Organization got a Sharia compliant loan from us to acquire their flex building at 82nd and Division. And it would have been amazing had that project move forward for the community, but it still is amazing that they weren't displaced from the community where they serve and were able to acquire their facility. Yeah, which will soon have an early learning space and community space. It's really, really exciting. I think they're having their fundraiser tomorrow night, as is Bienestar. So support one of your fellow nonprofits Thursday. I'm sorry. Yeah, thank you. It's Thursday night.
Is it public service announcement time? Well, I want to fanboy Craft 3 too. I mean, I think their first housing loan was to a Casa project, our first mobile home park co-op conversion that was 15, 16 years ago that was on the verge of dying. And they're like, we don't do housing lending. And I go, John, I'll make it worth your while. I don't care what you charge me. And indeed, he got it for us. And it's like, every 6 months you don't pay it back, the interest rate's going up a percentage. So, he structured it in a way. So thank you for shout out for the special things that CDFIs do. Next question. Or public service announcements? Yes.
What would you wait for me to get to just for a moment? Otherwise, the Zoom audience won't have the benefit of what you say. Pardon me.
Hi, Rachel Mockery. I'm with Corporation for Supportive Housing. We're another national CDFI. So we also do acquisition and pre-development lending here in Washington and Oregon. And I would love to keep the conversation going about what OHCS is talking about with pre-development lending. So I'll come find you guys after the call here, but also happy to talk to anyone else. Thank you.
Thanks. Okay, now remember, you don't have to be a CDFI to get a loan. As Dan has witnessed here. I mean, CDFIs are relatively new. So, you should feel free to call I'd say your local banker, but call your CRA officer at your favorite bank, call your commercial lender at your favorite bank, and ask them to take you out for lunch. Because banks will take you out to lunch. and they'll want to hear what you have to say, because they're keeping a CRA file on all of the people that they've met in the community and contacts that they've made, and, you know, times that they have tried to help you. And, you know, it doesn't hurt to say, hey, I'd like to go out to lunch and get a free lunch. So I encourage you all to do it. I hope I didn't put any of the bankers on the spot. Now, Beneficial is a foundation-owned bank, so it's a little bit different. Don't expect that they'll split. They will take you lunch. Okay, all right. Friday, I'll meet you at Portland City Grill. Thanks.
I love having lunch with the friends at Beneficial and other banks as well. And while we're walking to another thing to consider, again, just something like the financing for you as a nonprofit, building that relationship before you actually need money is a really good idea. Starting the conversation cold with, hey, I need money, and this is our first conversation, is less optimal than building that relationship over years and then keeping them abreast of what your needs are. Maybe having somebody on your board or on your finance committee is another way to kind of bring them into the fold. Again, planning for your future of your pipeline needs. And I think, I mean, bankers are nice people and smart and have a lot to offer to the community as well. And so that's a great way to engage them beyond the relationship, just helping them help you and to support your nonprofit.
Marian Bollery from Hacienda CDC. Maggie, KeyBank, Beneficial. Can you please take me to lunch?
More peanuts, more.
Reach out to funding that's coming up. A lot of it is fundraiser season.
Everyone give me a fundraiser out.
Yeah. No, but I do know that SEPA, Reach CDC, and Hacienda all have fundraisers in addition. Oh, PCRI, thank you, Judy. It's ain't no shame. NHA. Yes. Benefit, love it. Black tie Portland, come on. Who doesn't love that? Do you want to talk?
Do I want to talk?
No, do you want to talk?
Oh, do I want to talk? I don't want to talk, but yes, it talks. Yes, come on. Okay, she doesn't want to hold the mic. So we can let folks go a little bit early. Please do scan as you're walking out, and because we want to make sure we're giving you content that you need, and specifically call out those presenters that did a really fine job and those of us that need to work on our song and dance or something. Last chance for questions. I encourage you to not just reach out to those banks, introduce yourself, but ask them for help in the community, whether it's volunteer work, whether it's being on your board, whether it is, you know, sponsoring these events that are coming up. You know, they're accustomed to getting asked for stuff all of the time. So please reach out to them. Well, thank you, everybody. I'd like to thank my presenters up here and appreciate you all for coming in today.